Kothari, we're bringing you stories from the world of business policy and economy. We'll begin with markets. On my left is my colleague Karthik Malhotra as usual. Also joining us is Devang Mehta, who's the Director Equity Advisor, Spark Private Wealth. Devang, I will come to you in just a bit. Let me first quickly go across to my colleague Karthik. How are markets opening up?
Markets have opened a little in the red, Shweta. You look at the Sensex and the Nifty, they both opened down about 0.3%. I wouldn't really call it a gap down open, but it is a flattish open, mostly in the red. Let's look at the broad indices this morning. When markets opened 10 minutes into it at about 9:40 a.m., Sensex was down to about 65,593 levels, down about 0.3%. Nifty 50 within its range of about 19,500. Not sure if it's going to break through to the 20,000 levels anytime soon or not. Nifty Bank, Nifty IT, both in the red. Little surprise coming from the small caps, which have been about 0.5% or so in the green. Let's also look at the stocks in action this morning before we take it to Devang. And stocks in action, not surprisingly, include Adani Ports, which came out with the quarterly earnings yesterday. Excellent set of numbers yesterday. You also have a little bit of bloodbath in the, not bloodbath really, a little bit of scratches, skirmishes, and a little bit of redness in the banking stocks. Look at ICICI, HDFC, SBI. SBI, despite yesterday having broken the Reliance record of being the most valuable company on the Indian markets, still down in about 570 odd levels. Tata Motors a little in the green with, I think, the EV announcements that were made with respect to the company going on an overdrive with respect to both its Tata Motors cars as well as the premium JLR cars. And Coal India also, after the set of numbers that came out yesterday, trading a little in the green this morning.
And Adani Enterprises bearing some of their losses they made yesterday. So good numbers there for a lot of these companies. Let's quickly go across to Devang. Devang, what's pulling the markets down?
Good morning. Thanks for having me on the show. I think actually no reasons to complain. In fact, the rally that we had, the nature of the rally was extremely fast and furious. I think since March end, we never had a meaningful correction, and it was just a one way up. The trend was one way up. I think it was supported by a lot of fundamentals, a lot of macros, a lot of micros. Sentiment improved towards equity. There was sort of global turbulence as sort of also hadn't seen a heightened sort of a volatility across the globe as well. So I think all the factors, the confluence of factors led to this spectacular rally, and I think probably somewhere down the line there has to be some gravity, and that's what we are right now seeing. It's not sort of a meaningful correction as yet. It's sort of a correction or consolidation, if you put it that way. There'll always be ebbs and corrections on the way the earnings season sort of is on, and I think we are getting towards the fag end of it. Also a bit of macros in terms of the crude prices rising, in terms of also dollar index rising. There are a couple of this headwinds which have just come to the fore. So my sense is that yes, this is a correction which one has to take with both hands, with an open mind. And again, there'll be a lot of opportunities on the way. I think all the foreign strategist boardrooms have discussions about India. Nobody sort of can ignore India, as it's sort of again in the dark clouds. It's sort of a silver lining, as I always say. And also, if you look at the FDI investments over a period, India is sort of qualifying as an investment destination, be it China +1, be it Europe +1, anything. I think probably, yes, this is the correction. One needs to take it with an open heart, and sort of there can be some more on the table. But as I say, no reasons to complain. One needs to just stay focused on the fundamentals of India and sort of build portfolio that way.
Hi Devang, good morning. Nice to have you on the show. Help us understand this, this outflow on account of FIIs. Even though direct equity investors, DIIs, are more than making up for the losses, but why do we see this flight of capital when it comes to FIIs right now?
Extremely good question. I think what we have seen over the period is that FIIs and DIIs, it rarely happens in Indian equities. Both of them, a confluence of flows from both of them we saw in the recent past. The last 2-3 months, I think we have seen flows increasingly from FIIs, which to the better part of the last year were sort of absent. And it was only the domestic investor strength, the strength of retail investors, HNIs, family offices, ultra HNIs, mutual funds, PMSs, equity equities, direct equities, all this came to the market. I think it was ably supported by FIIs who sort of were in fact left out during the first part of the rally. The sense one gets here is yes, as equities reach towards a certain valuation zone, maybe right now India trades at around say 19.5 times 1 year forward. If you put a EPS of say 1050, 1100 for next year FY25. Yes, somewhere down the line, are we expensive? Slightly, yes. Probably we are not as expensive. We are fairly valued. There will be a lot of bottom-up opportunities. FIIs might probably book out for some time. The last 7-8 days we have seen sort of they're booking certain profits and they're getting out into equities, but it's not been as meaningful as it probably would. So my sense is FIIs will not ignore Indian markets for a longer duration. It may be a short-term phenomenon where markets would have rallied ahead of time, and there will be some profit booking on the table.
Okay, and what about these talks in the US right now of potential multiple rate hikes? What is that going to do to, let's say, investors, foreign institutional investors? How would they be reacting to more rate hikes in the US?
Yes, again, it's quite data dependent. We have seen just one rate hike a week back, and again, the commentary over there is more or less. They say that will be more data dependent. The inflation has definitely come down, but it's a sweet problem to have in a way. If you look at the consumer confidence index, if you look at the jobs data, I think US economy and a lot of parts of US economy are still doing extremely well. So I think the recession call a lot of people had is probably tapering down towards a slowdown type of a call. So if the recession doesn't happen, I think it augurs very well for Indian exporters as well. Yes, FIIs have their sight on developed markets, emerging markets. They have a lot of as such choices to make in terms of where they allocate their money. And India, I think, primarily rates among the top quadrant, maybe in the first couple of markets. So I don't think there'll be a long pause in sort of putting money into India or allocating more money to Indian equities. So I think that seems to be ruled out. Yes, there'll be periods of hibernation, a couple of months, a quarter or 2 quarters, and then probably again the flows can start resuming back.
Okay, and as far as the domestic India story is concerned, the RBI MPC is underway right now, and from what it seems, it is likely to be another pause, though we're going to get the fine print of that only tomorrow once the MPC comes out with its decision. But I think the market seem to be prepared for a pause. What happens if we actually see another rate cut or another rate hike in India?
I think probably you are right. Status quo seems to be the consensus call at this point, and I think inflation has sort of trend downwards in India as well. And RBI would also want to wait what the Fed does over there. The call seems to be more or less, as you said, status quo. It's more the commentary, whether it's hawkish, whether it's dovish, whether it's neutral. That's where the market participants would have their sights set. And I think probably we have seen sort of the worst of rate hikes in India, at least. And market is probably factoring in that we would probably see rate cuts in the next year, in the next calendar year, if not in the financial year at least. That is where most of the corporates have due their balance sheet. Most of the banks have sort of has healthy balance sheets to fuel the next round of growth. So I think this augurs very well if we somewhere pause in the rate hikes, which already RBI has done. And I think it's been extremely pragmatic in terms of its monetary policy management. That's one thing which I can say.
Okay, talk to us, sir, about mutual fund inflows at a 4-year high in this quarter. Data that came out suggested 1.85 lakh crore rupees invested by way of mutual funds. I'm assuming most of those would be retail investors. What is the mood for retail investors? What are they really seeking? Are they seeking alpha at this point, or is the tilt towards index funds, because index funds are also likely to deliver, passive investing is also likely to deliver better than average result?
A very good question. I think it's a combination of both. There is a population who sort of seek alpha. They go towards more or less active mutual funds or PMSs or direct equities and stuff. Yes, there is also a class of investors which have started surely, but slowly started to come up in India as well, right? You know that US is more or less dominantly being seen as a market where a lot of people invest in ETFs. The majority of the people at least do that. In India, yes, numbers do suggest that we have a plethora of money coming towards even passive investments or ETFs as such, or index funds, as a lot of this population also believes, at least to get get the market rate of return. It's very important not to get succumbed to FDs where you probably can't even beat inflation. So the answer is either go towards the ETFs or the index funds where you will get the market rate of return, or if you are seeking alpha, I think India is still a market where you can do a lot of bottom-up stock picking, be it large cap, be it mid cap, be it small cap space according to the risk appetite. So sense one gets here is that it's a combination of both. Retail investors have sort of matured over the period. They do a lot of SIPs, which is systematic investment plan in equity mutual funds. This over the last 6-7 years since demonetization, this number has been just creeping up. So that's a blessing in disguise, that any outflow that FIIs probably create in India, there is always a domestic cushion and a support which gets provided.
Got it. Talk to us specifically about sectors, sir. Sectors which, despite us all living in a very interconnected world and globalization, talk to us about sectors that are more likely to be resistant to whatever is happening in the world around us. IT sector, we have seen over the last quarter, IT results coming out, not really delivering great returns. In fact, not even meeting street expectations. Talk to us about which are the sectors that you think are going to be a little more resistant, insulated from what is happening in the world around us, whether it is the Russia-Ukraine war, whether it is rate hikes in the US or China's ghost factories.
I think that's where the bulk of the things will happen. I think domestic centric plays is one which will not have much of an impact if there is something wrong which goes across the world. And I'm no way saying that we are sort of decoupled, right? We are coupled for our energy needs as well. So anything that happens in the Western world or the developed markets or other emerging markets, we probably will have a bit of impact on us as well. But we would relatively sort of outperform. And in that sense, the sectors or the themes which look extremely interesting are something which I call a financialization, right? Or a credit growth as a theme. Financialization is India has seen people moving from savings towards investment. India has seen people moving from physical assets to financial assets. In that terms, a lot of your banks, a lot of your NBFCs, insurance companies, all this as a theme would do extremely well. So one theme which you can't miss, and it's a proxy play for the India economic growth, is something called financialization. The second theme which comes to mind is something called capital expenditure or capex growth. We have seen government doing a lot of capital expenditure over the last 8-9 years. The infrastructure has sort of seen visible changes in India, be it roadways, railways, metro, mono, highways, airways, ports. I think a lot of this infrastructure has got created in India as well. So this is something which public infra has been created. Private capex has also started to come back to the fore, which is also very important, right? So I always tell this, that railways used to have a capex of around 50,000 crore 3 years back. Right now the capex is somewhere in excess of 2 lakh crores. So that is where I think a lot of capital expenditure is also done by corporates in brownfield and greenfield projects. So this theme, as such, capital goods, cement, infrastructure, building materials, this theme will also sort of do well. And consumption has been India's strength. So sort of discretionary consumption, premiumization in terms of your auto and auto components, this sector also looks quite interesting.
Okay. And so talk to us also about the fact, since you mentioned infrastructure, we are also in an election year, and for the GDP to be kept intact and for the GDP to only grow, I think the heavy lifting will continue to be done by the government, while the private sector still holds on to cash to see what sort of a policy framework emerges whenever the new government is formed or the existing government gets a new term. So from a retail investor perspective, what should be the strategy right now? Buy the index, buy blue chip stocks on dips, or just continue with your mutual fund SIP routes? What is the best investor strategy that you can offer right now for retail investors, knowing very well that we are heading into election year and volatility cannot really be ruled out?
So, Karthik, a very good question again. But as I always say, that volatility has to be the friend of the long-term investor rather than an enemy. So, the sense one gets here is volatility will be the order of the day as we move ahead, because globally also, as I said, we are aligned, and there are a lot of factors which drive markets, be it sentiment, be it liquidity, and of course the earnings rule supreme. So, we feel that the earnings from here on for the next 3 years, we could at least have a conservative earnings growth for Nifty from let's say 13 to 15%, and there will be incrementally good earnings growth in good mid-size and good small cap companies. No way saying that everybody needs to get into that segment, but yes, one can also plan that one can invest in tranches. Probably in the next 3 months, 6 months, one can have a strategy where they can start investing in sort of SIPs as they regularly do that. They should also probably plan out and go back to the drawing board, look at the portfolio construction. If they already have a portfolio, get out of gruesome stocks. I think we have seen a lot of companies right now running ahead of fundamentals. The valuations have reached levels which are not sustainable. Somewhere some companies are not great in terms of the robustness of the business model. One should get out of that. One should probably buy companies where there is a very high degree of corporate governance, a very good corporate governance, ROE, ROC about 15-18%, revenue, PAT and EBITDA growth at a certain percentage. The size of the opportunity has to be large. These are companies have to be high market share companies, and there has to be something called margin of safety, which gives you good night's sleep and stress adjusted returns. So if one can find this type of businesses in the direct equity space as well, buy or accumulate this type of businesses over the next 3-4 months, and then probably one needs to give time for this types of businesses to sort of materialize over the next 2-3 years.
All right, Devang, before we let you go, also, as we briefly touched upon, RBI MPC is meeting today. We are likely to see some sort of commentary coming in from the MPC by tomorrow. What are your expectations like?
I think probably the rate call can be more of a status quo. The commentary which the participants want to hear, be it market participants, be it the economist, is how probably inflation will trend downwards, and what is the trajectory of the interest rates going forward. What are the growth parameters that the RBI is considering, whether it's pro growth, it's sort of pro I can say or an anti-inflation strategy, or a combination of both. That is what is more or less desired from the commentary and the body language of the governor whenever he speaks tomorrow.
All right, Devang, appreciate you joining us this morning and for sharing your wealth of ideas, inputs here on Newsline. We'll get you back very, very soon. Thanks very much. Shifting focus now, Karthik, to a very interesting, important story that we're tracking by the way of GST. GST on online gaming companies, which has so far continued to be a major cause of concern for a lot of online gaming platforms. We now know that the levy will come into effect from 1st of October onward, but companies seem to be bracing for what is likely to be a cash crunch for them. In fact, many of them are now letting go of their employees.
Yes, Shweta. I mean, one was not completely not expecting this to happen. It wasn't totally unexpected, but the rate at which it has begun to happen is something that I had not, in fact, anticipated. So companies are not even actually waiting for the 1st of October for the GST, 28% GST on face value to be implemented, and are already finding themselves in a situation preparing for the death blow that could be offered by way of this 28% tax, due to which cost cutting is a very, very obvious first step they have already initiated. MPL, Mobile Premier League, one of the major online gaming companies in India, has in fact yesterday let go of 350 employees already in anticipation of the higher tax outgo which is expected with this 28% GST. So, I mean, these were concerns that were voiced by the industry even last year, not just, when we started discussions around a month ago this year. But even last year onwards, these discussions have been on, where companies find themselves to be in a soup and have really been trying to push the government and lobby with the, with the corridors of power and ensure that this tax does not come their way. But unfortunately for them, this tax has indeed come their way, while Finance Minister Nirmala Sitharaman is fairly bullish and confident. In fact, even in Parliament, she mentioned that that the GST collection is going to soar thanks to this 28% tax on online gaming. But unfortunately, companies like MPL have already decided to cut on their expenses, and employee cost becomes one major hit. So 50% of their India team, amounting to about 350 people, are going to be let go of. And MPL is not alone, but let's just finish off on the MPL bit. And if we can pull up that that code graphics from Sai Srinivas, the founder of MPL, And he pretty much says that the new rules will increase the company's tax burden by as much as 350 to 400%. And he says that as a business, one can expect or be prepared for a 50% or even a double 100% increase. But adjusting to such high volumes and a sudden increase of a magnitude which could have an impact of about 350 to 400% on additional tax outgo is something that is compelling them to take some very tough decisions. And these tough decisions indeed are letting go of half their workforce. But that's not all. I mean, there are other, cost corrections or cost mitigation steps that the company is taking, which also includes, the cost outgo on servers and office infrastructure, etc. But I think a sunrise sector and industry which was attracting a lot of eyeballs, attracting a lot of gamers, a lot of audiences in that sense, had the potential to rake in revenue through advertising, revenue through subscriptions, memberships, etc., is now finding itself in a scenario that it's unlikely to see a sustainable business model going ahead. And these drastic measures of trimming down half its workforce are already in action. But MPL, of course, is a large company. There's another company, Gurgaon-based company called Quizzy. And Quizzy, in fact, yesterday, its founder announced on LinkedIn that it's not just letting go of people, it's shutting shop completely. So
the business is no more lucrative.
So the business is no more viable. And let's look at the sort of, the strong words coming out from the founder of Quizzy, Sachin Yadav. And he says that recent developments in the tax landscape and regulatory environment has left the company with no choice but to bid farewell to its beloved gaming venture. That's not all. He's used some pretty strong words. And let's move on to the other quote that has come from Sachin Yadav. And he says that the introduction of a 28% GST on entry fees has compounded the company's woes, and he's used the word murdered and murdered the industry finally. So not great news coming. I don't know if the government had anticipated this. In fact, a few weeks ago when you and I were sitting right here in the studio, we had put up certain questions to the government ahead of its decision to finally, in the 51st GST Council meeting, to eventually come out and make the final decision on what is the GST levy going to look like. And we had raised these potent questions, and one of those questions was about the future of these online gaming companies. And these gaming companies, unfortunately, are falling off the wayside by way of this 28% GST. All
right, let me also call in my colleague Amit into this conversation. Amit, you've tracked startups. Please do join us. You've tracked startups. You've tracked, companies such as Quizzy. What appears to be an eventuality of this would be many of these companies will eventually fall off the radar. There'll be consolidation. Companies that cannot sustain a debt burden of up to 304%, tax burden of 3%, 300%, 400% will not continue to sustain, which is what's happening in this case. So essentially, half the players, which are startups in the online gaming space, will be out of business.
It's a strong medicine that the government has put on them. They'll be probably collecting bigger GST, but I do not know if that works. If most of the companies are not there, where will they be collecting from? But there's a little bit of a good news which I touched upon yesterday. Is 50 million a good number? Dollars?
It depends on the context. If I had a $50 million in my
it's a very good number.
M1X1 from Japan has set aside $50 million to be invested in the gaming sector of India.
Okay.
I'd say set aside that corpus.
I mean, compare it to $1 billion of investments that came in last year. 50 million is a drop in the ocean. So, I mean, you're talking about 1,000 million coming in last year by way of, or was it 2 billion? I think it was.
The entire foreign direct investment into the gaming sector has been 2.5 billion.
2.5 billion. So you're talking about 2,500 million. So 50 million, yeah, okay, sure.
Relatively less,
a sliver of hope there.
But a sliver of hope at a time when the industry is going through perhaps a possible crunch, not right now, will be in the future. But, you know, my question essentially is, with a 28% GST levy, and I understand when the government says we want to tax every possible company out there, and gaming, online gaming, casinos, horse racing should not stay out of taxation ambit.
Right.
But to levy a 28% GST is far too much. It could have been at 18%, which is what the industry was also demanding.
The problem, I think, Shweta, is not as much with 28% as it is with tax slapped on the face value. So a gamer invests, sort of parks 100 rupees to play, 28 rupees straight away goes to the government. So what is left for the gamer to play with is 72 rupees. So if it's a real money game, and even if a rupee has to be earned on that 100 rupees, it's actually not going to be a rupee, it's going to be 29 rupees. Because you've got to recover the taxes that you have paid already to earn that 1 rupee in winning. And then that 1 rupee is subjected to a 30% TDS. So what are you left with? So the broader point is that, yeah, I mean, mathematically, it's a great formula. A higher tax, ceteris paribus, is going to increase the tax collection, is going to give more money in the coffers of the government to the exchequer. But logically, I mean, that's the difference between math and logic. I think logically, a gamer would be deterred to start playing money games on a platform that levies 28% tax. And hence, in this mathematical quest of increasing the tax collection, perhaps logic was kept aside, not hoping or not realizing that this money could also flow out of the shores of India for gamers to find ambits to play on platforms not registered in India.
But the government now says that you've got to have a representative in the country, even if you're not registered in the country, and you would be subject, whether you are an India player, whether you're an outsider, you'd be subject to a 28% GST levy.
I mean, if companies see that there is a lucrative market in India where there are millions of gamers, they would want to, they would not mind foregoing this GST and paying tax in the country where their audiences are. I'm not sure if it works technically that way, because it is also then a function of double taxation for those gaming companies. And what is the kind of jurisprudence that India would have over territories where these gaming companies are registered? So, I mean, I think all that is a matter of longer discussions and further investigation to see, what sort of tax liability can the Indian government strictly impose on companies not registered in India, even if they're doing business in India. But I think, yeah, to look at it in this context, you would see a decline in gaming activity on real cash games for sure, because gamers would not be happy paying 28% straight on any 100 rupees that they invest on or spend on the platform.
So
I think the real cash probably may just stay, because those are addicts. The cash players are addicts. That's why they so probably they'll stay. So government probably knows that.
Okay.
That's my speculation.
Sure.
All right.
Sure.
We'll see how true that is. I think we'll get to know in about a month or 2 months' time, rather, by 1st of October, end of October perhaps.
So I think 1st November is when we should have a 1 month tax collection data and try and drill down how much of that came from online gaming companies. But unfortunately, Shweta, just one more point before we add on. It's not just startups that are dominating the gaming industry. In fact, you have listed companies as well, Gamecraft being one of them, Nazara Technologies being one of them. You have fairly large listed companies, who are also accountable to their shareholders and who are accountable to their employees, and these companies also happen to to find themselves in a difficult spot. So we'll also have to look at their quarterly earnings 1st October onwards, Q3 earnings, and see what sort of profit after tax
GST outgo.
Yeah, and I think the government also needs to realize at some point that you have tried to make corporate tax, not GST, corporate tax more attractive. You've got a reduction from 30% to 22% on corporate tax. But one of the discussions in Parliament yesterday actually suggested that FY 2021 actually saw a loss of almost ₹1 trillion, 1 lakh crore rupees on account of this reduced corporate tax. So you are letting go of corporate tax, which is allowed to operate at a lower rate than income tax for individuals, individual income tax, and yet you're charging GST on face value on sunrise sectors. So I think this whole mapping of how the government wants to collect its revenue needs a very serious relook.
All right, a serious relook, of course, is what the government will have to do. Numbers will come out, numbers will make it clear whether GST collection, by the way of a 28% levy on online gaming, will add substantially to revenues. Will of course bring those numbers up, but let's move on. Let's move on to another important story that is coming by the way of the electric vehicle space in India. A lot of new entrants, a lot of new additions to the portfolio of various existing EV players and companies that are looking to expand into EV business in years to come, perhaps.
Absolutely, Shweta, and I think EV is a sector that both of us, in fact all three of us, have been tracking fairly closely, even though we've been doing that sitting in our studios and not really have had the opportunity to go and speak to a lot of four-wheeler EV makers yet. But I think great news coming in from this whole electrification drive that Indian automobile makers have embarked upon. And let's look at the data that is coming in from Tata's 58th AGM that was held yesterday. And Tata has some fairly aggressive, extensive EV plans, to a point that it's saying that 50% of its Tata Motors fleet is going to turn electric by 2030. And the government's target is 30% of all four-wheelers operating in the country to be electric. Tata Motors has upped that by 20%, saying that 50% of its fleet is going to be electric by 2030. And on the premium side, which is JLR, a company that Tata Motors bought, a UK-based company that Tata Motors bought, 65% of JLR's fleet is going to run on green technologies. Not necessarily electric, but green technologies. So we'll come to what green technologies also are. Now, back home, I think domestically, electric versions of the Tata Harrier, the SUV, and it's been a sort of bestseller SUV, one of the one of the cars that has been able to adapt the best of JLR's design and the ruggedness required on Indian roads, and sold like hot potatoes. Well, not at the price at which potatoes are selling today, but anyway. So an electric version of the Harrier is expected to be launched this year, along with the electric version of the Punch, which is their entry-level small car. And there's a new Curve electric vehicle which is likely to be launched in Q1 of FY25. So April, May, June,
by this time next year,
by around this time. A little earlier than this time next year is when we should expect the Curve to be launched as well, a fully electric vehicle. Now on the premium side, JLR is likely to take all electric Range Rover and Range Rover Sports orders beginning this year, and the sedan Jaguar is going to come with all electric vehicles across the whole series of JLR by calendar year 2025. Now specifically, let's look at also the other sort of joint ventures that Tata Motors is doing, and this one comes with the technology company called Cummins. And Tata Motors has invested in hydrogen technology through this JV with Cummins, and apparently the green energy that I spoke about just some time back is not necessarily going to be all electric. This green technology could also come by way of hydrogen based internal combustion engines. So the ICE technology, instead of being dependent on fossil fuels like petrol or diesel, could actually look at hydrogen being the input into the engine. So it's not going to be all electric, but I think the remnants of the traditional automobile ICE engines that we know are also going to get a nice greener tinge to them with this hydrogen fuel coming in, except that Tata Motors is right now saying that it may not be looking at hybrid at all. That's on the Tata front. I've also got some news on Hyundai and Kia, but we could
and
come
also
to that. Also
Maruti for that matter.
And Maruti.
Yes.
Now on hydrogen, a few days back, even Reliance announced that they are going to be offering affordable hydrogen fuel for the India markets, and they are going big on it. So that the alternate fuel for on petrol is not just EVs, as you mentioned. Big companies are looking at hydrogen in a very confident manner, if I may say so.
And that is important because, I remember about a couple of months ago, we were discussing future of mobility, and one of the key crucial aspects that we talked about is whether EVs are the future of mobility, what happens after a certain point where there are enough number of electric vehicles on the road but not enough charging infrastructure, or generating of electricity is also a major constraint. So what other alternatives do we have that are greener and not just vehicles that are powered by electricity?
That's right. I think that's exactly where hydrogen-based ICE engines come in, and even the hybrid technology, which gives you a much better mileage on every liter of traditional fuel that goes into the tank. So I mean, while the pollution is not going to be any greener, but at least in absolute terms, over a period of time, when you drive the car, it's way lesser in a per kilometer fuel consumption and fuel-based pollution emission. But let's move on to Hyundai and let's look at the data which is coming from Hyundai and its sister concern Kia Motors as well. You spoke about this aggression of Indian automobile brands taking to greener routes, and Hyundai is saying that it's going to launch 5 new electric vehicles by 2032. I'm not sure for the second largest automaker that's a big enough number. Right now, it's just got 2 electric vehicles on the roads of India. One, of course, being the Kona, the other being the Iconic. Both of these ultra expensive, if you ask me. I think difficult for a middle class salaried employee, people like us, to afford those cars just yet. But you spoke about charging stations and charging infrastructure, and Hyundai is also likely to invest in that, and is saying by 2027 it's going to have about 440 odd charging stations installed across India. Not sure if that's a big number. 440 doesn't seem like a big number, but at least an automaker looking at after sales, looking at pretty much what we could otherwise refer to as the petrol pumps, right? So this is the downstream of driving an electric vehicle. In addition to that, it's saying that it's pledging to invest 20,000 crore rupees in its Tamil Nadu plant over the next 10 years, which is likely to give a boost not just to the domestic consumption of the electric vehicles or the traditional fuel vehicles that Hyundai is producing, but also the export cycle. Let's move on to Kia Motors, and Kia Motors is saying that it's now looking at producing a small-sized EV, a small-sized EV pretty much like the likes of MG Comet perhaps, specifically for the Indian market. So while its fleet of Seltos, Sonet, Carens do not have electric versions yet, it's looking at getting a small-sized EV specifically for the Indian market. Remember, Kia Motors is a sister concern of Hyundai Motors, and the brand also hopes that it can take up its market share from about 6 to 7% right now up to about 10% in coming years. Now, since we're talking about EV, I think we can't leave behind Tesla. We can't leave behind MG Motors. So Tesla, as we know, we're just recapping for our audience, has initiated talks with the government to have a 24,000 USD, or at present conversion rates, a 20 lakh rupee car specifically made in India, Tesla, for the Indian consumer. In addition to that, of course, we see that MG Motors and BYD, Build Your Dreams, the Chinese brands, are facing trouble in India right now because of their Chinese roots and Chinese connect. So that's right now how I see the auto space in EV panning out.
And MG, of course, looking for an Indian partner, which it has made clear so far that they are looking for a majority stakeholder, a company which is Indian essentially, so they can, in a sense, surpass their existing troubles with Chinese ownership. Yes, Amit.
Just to add to that, how serious at least Tata and Hyundai are about EVs is Tata Power, not Tata Motors, has already gone into a joint venture with Hyundai Motors to set up DC 60 kV charging stations across 29 cities right now, and these will be on the Hyundai dealerships. Right now, the Hyundai dealerships have a 7.2 AC kilowatt hour charging stations. So it will be upgraded to 60 kilowatt, and this is a joint venture between Tata Power and Hyundai. So that's how serious at least these two companies are about building not just their cars but the infrastructure across India.
All right, of course, and we'll continue to bring you details, but let's quickly move on to a story that we're tracking from the US at this point in time, and that is with respect to consumer credit card debt. Over $1 trillion, Amit. These are staggering figures. Explain to us what's happening here.
I think let's instead get to Indian credit cards because we are getting a little short on time.
Let's talk about Indian credit cards first.
Because this was up in the parliament also yesterday for debate.
It was a report that was tabled by Minister of State for Finance, Mr. Bhagwat Karad. If somebody can pull up the graphics,
let's pull up those numbers, please. Yes.
So, if I can go there. Yeah, so credit card defaults have risen to a staggering number of 4,072 crores this year. They were up from 3,122 crores last year. So it's quite a bit of a jump. You can go on to the next graphic. Outstandings were up to 1.64 from 1.64 to 2.1 lakh. Gross
lakh crores. That's
lakh
a
crores,
trillion
lakh
we are
crores.
talking about. We are talking
Lakh-
about
Two
credit card
trillion
outstanding
rupee.
up to about 2.1 trillion
Yes.
as compared to 1.6 trillion in the year ago period.
Okay. Gross non-performing assets in credit cards stood at 1.94%. They were up from 1.91%. I must add here, in FY22, they came down from 3.56% in 21. So they were down a little up. So gross,
Which essentially means people are paying back.
Yeah, but I'm still worried about a 4,000 crore rupee figure when it comes to defaults. These are defaults. These are people unwilling to pay or unable to pay,
Unable
as the
to pay.
case may be. It talks about gaps in the system, you know, which should not have allowed these people to hold credit cards. Why are they credit worthy if they are unable to pay a tune of 4,000 crore rupees to the banks?
Yeah. We'll come to frauds. 791.4 crores in FY23, up from 536.5 crores in FY22. So they just went up. If we can come to the next one, in 21, even it was even lesser than that. It was just this much in the, 435 cases, north of 500, and close to 650 cases this year in frauds alone.
All right, so some staggering numbers.
Staggering numbers.
What's exactly happening here? We run out of time, Karthik, but from what I know, people are taking on more debt than they can repay.
So, Shweta, I would not want to completely discard any correlation between the numbers showing up as defaults along with the fraud numbers. You know, some of these could perhaps be attributed
Understood, of course.
to cases under litigation or under discussion between the bank and the consumer or the banking ombudsman or the RBI, that should these defaults be written off as NPAs or frauds, or should these defaults continue to stand on the statements of credit card holders? But I think the moot point here being that RBI has to ensure that credit rating agencies which work on data perhaps provided by the banks has to be accurate, updated to a point that banks do not issue credit cards, despite it being a very lucrative business for banks themselves, should not be allowed to offer credit cards to uncredit worthy individuals in the country. And I think that is something that has to be taken up very, very seriously.
All right, the numbers of course present a major challenge. Yes, Amit.
Yeah, just a little upside. If credit cards defaults, frauds were 1.94, gross non-performing assets of banks in credit cards, the total gross non-performing assets of commercial banks was 3.87%, so much more.
Okay.
So non-credit cards, non-performing assets with banks also is a big
all
chunk
right,
of
all right. But 1.94% is still
It's still
a
a big
substantial number. We will of course keep bringing you those details. But that's all we have on the show. Thanks very much for watching.
Pakistan is actually genociding Baloch people. So being Baloch is a crime. If you are a Baloch, it means in the eyes of Pakistan, you don't have any right to live.
The Chinese and Pakistanis are colonizing the Baloch and exploiting their resources.
The Baloch armed struggle will continue unless China withdraws, the Pakistan military withdraws from Balochistan, and give Baloch complete authority to decide for themselves.
The Baloch feel that if they don't act now, they will become marginalized.
What lies ahead for Balochistan?
Balochistan, Bangladesh 2.0, streaming now.